Hello. In this video, we're going to talk about distributing sales leads in an outbound telemarketing organization, and specifically how to use your existing sales analytics to make sure distribution decisions are made to maximize revenue. Businesses acquire leads through many different activities. Some of the more common lead sources are listed here, and you're likely using one or more of these, like TV infomercials, radio spots, space or print ads, corporate websites, etc. The goal of any marketing company that generates leads is to get those leads to the right salespeople, usually as quickly as possible, while the lead is still hot, to maximize the dollars earned per lead. To see how we approach this in direct results telemarketing, we're going to cover a few sales concepts. We're going to cover how we measure sales performance and how we use that performance data to assign leads to marketers. We will look at a few metrics that help us measure sales performance. One is cost per lead, or CPL for short. The other is dollars per lead, or DPL. And the third is sales ratio. We're going to cover each one of these concepts. Let's begin with cost per lead, or CPL. Each lead has an associated cost. It is calculated by dividing the cost of advertising by the number of leads that ad generated. It's usually referred to as cost per lead, or CPL. This is how much it costs to capture or buy one lead on average. For instance, if you run a TV infomercial, your leads can cost you $100 or more, whereas if you buy leads on a pay-per-click campaign, the leads may have a lower cost of $25, and leads generated through an organic squeeze page or an affiliate page may have a cost of $5 per lead. As cost of media and advertising rises, our CPL rises. We see that year after year. If you advertise on TV, radio, or the internet, you already know this. That is getting more and more expensive every year. If you pay $20, $30, or $50 or more for your leads, you want to make sure that those leads are attended to by your sales team. You want to make sure that your team does their best to reach those leads and present your offer. You want to make sure that the leads are not falling through the cracks and that you are getting the maximum sales possible from each lead. In DRT, or direct results telemarketing, we use some simple metrics to measure performance of marketers to make sure they are maximizing your leads. One simple way to measure performance of a marketer, team, or a call center is to compare how much revenue they generate, or dollars generated per lead, and compare that to the cost per lead for the number of leads given to them. We're going to cover that in this video. Dollars per lead, or DPL, is defined as the average number of dollars generated per lead assigned to a marketer or assigned to a sales team or call center. We're going to do a use case study to make this clear. So let's assume you aired an infomercial that cost $15,000 for that particular airing, and you received 150 leads from that airing. That will give you a cost per lead of 15,000 divided by 150 lead, which equals $100. Now we got to send those leads to your call centers as soon as possible so marketers can contact them and make sales. You distribute these leads equally amongst your 3 different call centers. So each call center will receive 50 leads, and at $100 per lead, they're receiving $5,000 worth of leads for that batch of leads that week. In our example, our California call center manager, she receives her 50 fresh leads. Now she's got to decide how to distribute these leads among her various sales teams to maximize her sales. She is ultimately responsible for the performance of her call center and the dollars that she generates. So she's going to base her decision on the most recent performance of each of her teams. She manages 2 teams. One is called Winners, and the other is called Majestics. She decides to give each team 25 leads. So she's distributing it evenly because of prior week's performance. The two teams performed equally well. However, a week before that, she did not distribute the leads evenly. That week, she gave 30 leads to winners and 20 leads to Majestics. So she has the ability to decide what will work best for her call center and assign leads accordingly. But in this case, she's given them 25 leads each. Our teams in this example have 5 members each, and the team leader is circled in red here. The team leader is the individual who is responsible for the performance and sales of the entire team. He's responsible for all of his marketers. So each team is given 25 leads, and team leader of winners receives his 25 fresh leads, and he must decide how to distribute his leads among his marketers to maximize his team's sales. His decision is again based on recent performance of each marketer. Now, when we say he receives his leads in direct results telemarketing software, managers use a program called lead assignment. It uses a trickle-down lead assignment model, where leads are assigned by the general manager to his call center managers, and then call center managers in turn decide how many leads to assign to each team, and they assign their leads to each team, and then the team leaders in turn decide how many leads to assign to each marketer. And usually all of these decisions are performance based. The salesperson who performed best the prior week or has the best track record usually gets either the best leads or gets more leads. Our team leader has to decide how to assign leads to his marketer. He has 4 marketers, but he has 25 leads to assign to them. So he decides to give each one of those marketers 5 leads each, and give an extra 5 leads to his star marketer, who is the person who had the best performance the prior week. And this is usually how leads are assigned in a sales organization. Or maybe he'll give him the leads that spent the most amount of money on the front end transaction. So the best performer usually gets the best leads. So a week later, the numbers are in. Each marketer has had 1 week to contact the leads and try to make a sale. A week later, reports are run to see what the outcome is. Our team winner's total sale is $6,000, and team Majestic sales are $5,000. So we're gonna now drill down and look at their dollars per lead. For team winners, the total sales was $6,000. They were originally assigned 25 leads. So we divide 6,000 by 25, and that gives us $240. On the average, they generated, for every lead that was given to them, they generated $240. For Team Majestics, the total sales for the entire team for the week was $5,000. They were given 25 leads also, and their dollars per lead comes to $200. So team winners outperformed Team Majestics this week. Team leaders in direct results telemarketing can run reports and review the performance of each team member or marketer. They can see which marketers are doing better with the leads. Are they reaching their leads? Are they closing enough sales? How do their numbers look in comparison to the rest of the team? These metrics allow the team leader to work with individual marketers to help them improve in specific areas. Back to our example, the California call center manager is going to look at her numbers and run her reports in direct results telemarketing and see that she's had a total sales for the week of $11,000. She was given 50 leads by corporate, so her average dollars per lead for her call center is $220. And as we go up the ladder, we look at the performance of each call center. Our Arizona call center, their total sales was $10,000, and with 50 leads, that gives them a DPL of $200. California call center we already looked at with a DPL of $220. In Nevada, her total sales for the week was $12,000, and with 50 leads, she's had a DPL of $240 per lead. So Nevada this week has had the highest dollars per lead. And we look at the numbers for the entire organization. So we're going up the ladder. the number for the entire organization, the total sales was $33,000. Divide that by the 150 leads that were generated by running that infomercial, and we'll get an average DPL for the entire organization of $220. So we have an average DPL of $220 and cost per lead of $100. If you recall, we arrived at the cost per lead by dividing the cost of running that infomercial for that airing, that was $15,000, and we divided that by the number of leads that were received directly from that particular airing, and we had received 150 leads. So we divided 15,000 by 150, and that gave us a cost per lead of $100. So now to arrive at our sales ratio figure, we divide our dollars per lead by our cost per lead, and we'll come to our sales ratio. In our example, we will divide 220 by 100, and we get a sales ratio of 2.2. This ratio tells us that on the average, for every dollar spent on a lead, $2.20 in sales was generated in the prior week. And if everything remains the same, we can expect the same type of revenue in the following week. So for every dollar spent on advertising or lead generation, we can expect $2.20 in sales. Call centers can use this figure as their minimum sales target. Marketers would be expected to hit this target every week. This in effect becomes the yardstick to measure performance of marketers, teams, and call centers. Any marketer, team, or call center that generates a higher dollars per lead is performing better than average and may receive bonuses or more or better leads. And any call center, team, or marketer that is below our dollars per lead is subpar and should be reviewed. Direct Results Telemarketing's reports provide these figures at every level so you can accurately measure the performance of your sales units and set sales targets for them. You can specify the target in each script or presentation, and that number appears on the marketer's console screen. They actually see a graphic bar chart showing them exactly what their personal sales target is next to a column showing them their current sales, so they can see clearly where they are now and where they need to be. And they also see their team's sales target, so cumulative sales for their team and cumulative sales target for their team. They're contributing to the overall team effort, so they can see where the team is. So in addition to the many performance reports that are available, we have a few reports to help ensure leads are being attended to. Our neglected opportunities report lets you zero in on leads that are being neglected by marketers or teams or call centers. Again, leads are very expensive these days, so you'd want to know if a batch of leads is sitting somewhere and not being worked on. So this unique system allows you to set parameters like the number of days within which a marketer must contact or attempt to contact a lead. Let's say you set that parameter to 5 days. If a marketer fails to contact the lead within 5 days, his team leader would be notified. And this ensures that leads do not fall through the cracks and every lead is attended to and sales are maximized. Direct Results Telemarketing streamlines the distribution of leads. It enables general manager or his staff to assign leads based on recent sales performance analytics. Call center managers and team leaders also can maximize their DPL by assigning the best leads to their star marketers. Sales targets can be adjusted as often as necessary to reflect the most recent performance. This establishes achievable targets for marketers, targets that are credible and based on the realities in the call center. DRT, or Direct Results Telemarketing, tracks sales and performance at every level. Marketers can view their performance and personal goals on their screen. They view it every day. And again, we use charts and graphs and very simple language to quickly convey that information. The system is so easy to use, especially for marketers. Marketers Console is so easy to use. Marketers are up and running literally within minutes. If they know how to browse the internet, they'll already know how to use this program. And this same concept of ease of use is carried out throughout the design of the software. Menus and reports are very intuitive and self-explanatory. Team leaders, call center managers, and executives receive daily and weekly reports by email. So even if they don't log into the system, they receive their email. A lot of managers prefer to receive their emails on their mobile device, so they get it on their phone. It shows them their sales for the day and for the week, and who the star marketer was and the star team was in that call center for that week. So this team-based hierarchy of the system encourages a healthy competition among marketers, teams, and all call centers. This concludes this video. If you'd like more information, please subscribe to our YouTube channel and visit our website at www.directresultstelemarketing.com. Thank you.